Welcome back to the deep dive. It is February 2026. And if you have been working in tech or frankly just using software over the last few years, you've probably felt like the ground is shifting under your feet. We aren't just talking about a new version update or, a faster processor anymore.
No, we are really talking about a fundamental change in the entire architecture of work.
Exactly. For the last 20 years, we've lived in the era of software as a service. You buy a login, you sit down, you type into a box, you get a result. But looking at the source material we have today, specifically the Salesforce Q4 2026 earnings call and report from February 25th, that era might effectively be closing. We're looking at a manifesto for something they are calling the Agentic Enterprise.
It really does feel like a demarcation line in the history of the industry. The narrative has moved from, here is a tool for your humans to use, to here is a digital agent that does the work alongside, or even instead of your humans.
And that is exactly our mission for this deep dive. We are going to cut through the buzzwords. We really need to understand if this agentic shift is just marketing hype to bump the stock price, or if companies are actually handing over the keys to these AI agents. Because let's be honest, agentic enterprise sounds cool, but it also sounds a little like, a sci-fi movie where the robots take over.
Right, and judging by the numbers Salesforce just put up, companies aren't just handing over the keys, they're paying a massive premium for the privilege.
So let's set the stage. Because leading up to this earnings call, the mood in the tech world was, let's call it anxious. There was this prevailing theory floating around called the SaaSpocalypse.
A Syspocalypse is a dramatic name, but the fear was very genuine. The theory went like this. If AI can write code, and if AI agents can build their own interfaces on the fly, why do we need massive, expensive software suites like Salesforce? The fear was that AI would commoditize the software layer completely, turning these giants into dinosaurs.
Right, why pay for a CRM when an AI can just build you one from scratch? And Mark Benioff, the CEO of Salesforce, he didn't shy away from that on the call. He actually seemed to be enjoying the doom-mongering a little bit.
He certainly had a rebuttal ready. He joked that the Saspocalypse was actually getting eaten by the Sasquatch.
The Sasquatch. Okay, unpack that metaphor for me.
It's his way of describing the large incumbents, the big enterprise companies. His argument is that rather than destroying software, AI is making the Sasquatches hungrier. They are consuming more software because that software now includes the agents they need to survive. And if you look at the financial fortress, as he called it, that Salesforce has built, it's pretty hard to argue that they are dying.
Let's look at that fortress, because the numbers were staggering. Revenue for the quarter was $11.2 billion, which is up 12% year over year, and full-year revenue hit $41.5 billion.
Which, for a company of that massive size, is significant growth. But the revenue isn't actually the most interesting number here. If you want to see the future health of a software business, you have to look at the RPO.
RPO. We hear this acronym a lot in earnings calls. Break that down for us. Why does it matter more than the cash they just put in the bank?
RPO stands for Remaining Performance Obligation. Think of it as revenue that is locked in by contract but hasn't been recognized yet. It's the backlog. It's the future cash flow that is legally guaranteed. And that number hits $72 billion.
$72 billion.
Yeah. Benioff called it one of the best performances in software ever. And that effectively kills the narrative that customers are fleeing. You don't sign $72 billion worth of future contracts if you think the vendor is about to become obsolete.
True. But I have to play devil's advocate here on one specific number. They announced a $50 billion share repurchase authorization.
Yes, a massive buyback.
Okay, so $50 billion. When I see a tech company buying back that much of its own stock, I get skeptical. To me, that can signal that they have run out of ideas. They have all this cash and don't know how to spend it on innovation, so they're just giving it back to shareholders to prop up the stock price. Is that what's happening here?
That is a very valid criticism, and it's one that analysts often make. But Benioff framed it differently. He called it a dislocation in the market.
Dislocation, like a disjoint between value and price.
Exactly. Basically, he believes the current share price does not reflect the reality of their cash flow and their growth potential with these new agents. In his view, the stock is on sale. So the best investment Salesforce can make right now isn't some risky acquisition of another company. It's buying Salesforce.
So it's a massive bet on themselves.
It is. They also raised the dividend by 5.8%. It's a signal to Wall Street that says, look, we are not a volatile startup anymore. We are a cash-generating machine. They're trying to have it both ways, offering the stability of a blue-chip stock and the growth of an AI startup.
Okay, so the bank account is healthy, Syspocalypse is canceled. But let's get into the why. Why are companies signing these contracts? Because it's not for the old CRM, it's for this new agentic stack.
Right. And this is where we need to get a little technical, because understanding this stack is the only way to understand why they think they have a moat. Benioff made a point of saying this isn't just a chatbot, it's a layer cake of technology, and every single layer matters.
So walk us through the cake. What's at the bottom?
At the very bottom, you have the models, the LLMs. You've got Anthropic, OpenAI, Llama from Meta.
And Salesforce doesn't seem to care which one you use, right? They were very clear about that.
No, they are totally agnostic. Benioff actually said, "We love all our children equally." And that is highly strategic. If they tied themselves to just one model, say just OpenAI, and then Anthropic releases something vastly better next week, Salesforce would be in trouble. By being the platform, they win no matter which model is smarter on any given day.
Okay, so the brain comes from the LLMs.
Yeah.
But we have all seen what happens when you just let an LLM loose. It makes things up. It hallucinates.
Exactly. A brain without memory is useless, and a brain without context is downright dangerous. And that brings us to the middle layer. They call it Data 360. This is arguably the most important part of the entire stack, and it's where they claim their true advantage lies.
Why is this layer so critical? Is it just a database?
It's much more than that. Think of it this way. If you ask a generic AI, "How is my customer Bob doing?" It has absolutely no idea who Bob is. It might hallucinate a story about a Bob. But Data 360 connects that raw intelligence to your actual historical business data, whether that data is living in Snowflake, Databricks, or even an old IBM mainframe in the basement.
So it gives the AI the ground truth.
Precisely. It anchors the AI in reality. It knows that Butt returned a toaster 3 years ago that he usually buys during the holidays, and that he currently has an open support ticket. Without this layer, the agent is just a parlor trick. With it, it becomes an employee with deep institutional memory.
And then sitting on top of all that is Agentforce.
Correct. That's the control center where you build, manage, and unleash these agents. But on this call, they introduced a new metric to measure this, and I think it's going to become the industry standard. They called it the Agentic Work Unit, or AWU.
Yeah, I saw this mentioned by Patrick Stokes, their chief marketing officer. Why do we need a new metric? What was wrong with just counting tokens? Everyone talks about tokens in the AI space.
Well, think about the difference between electricity and a finished product. A token is just a raw unit of processing. It's the electricity. You can use electricity to power a life-saving heart monitor, or you can use it to power a neon sign that says open.
And right now, the industry is just charging for the electricity.
Exactly. Stokes pointed out that you can burn 1,000,000 tokens having an AI write a poem about a cat. That is technically AI usage, but it has zero business value. The AWU measures actual outcomes.
So what counts as a work unit then?
A record updated, a workflow triggered, a decision made. It is the fundamental shift from paying for AI to think to paying for AI to do.
And what is the volume here? Are people actually using this in the real world yet?
They dropped a wild stat on the call. 2.4 billion AWUs delivered to date, with 771 million in the fourth quarter alone.
That is nearly 1 billion discrete actions taken by machines in 3 months.
It proves this has moved way beyond the experimental phase. This is production-grade work happening right now.
Okay, so that is the theory and the architecture. But I want to know what this looks like in the wild, because they brought out some very different case studies, and I really want to unpack them for you. The first one is Shark Ninja.
Shark Ninja is a great example of speed. They make consumer products, vacuums, blenders, and apparently slushy machines.
Yeah, Benioff actually mentioned he has the slushy machine, made mango sorbet with it.
Which is a charming little detail, but the business problem they were facing was very serious. They launched 25 new products every single year.
That is a nightmare for customer support.
It is, because every time a new product drops, you have thousands of customers asking, "How do I clean this?" or "Why is this red light blinking?" Usually that completely crushes a human support team. You have to retrain everyone constantly.
So how did they use the agents to fix that?
They deployed a guided shopping agent and a support agent. But the key takeaway here was the timeline. They did it in 8 weeks.
8 weeks. In the enterprise software world, fast usually means 8 months.
Exactly. They got it up and running right before the holiday rush. And the result was 250,000 consumer engagements handled entirely by agents in Q4.
And Mark Barocas, the CEO of Shark Ninja, said something that really struck me. He said they moved from viewing service as a cost center to a growth engine.
That is the holy grail for any business. Usually customer service is just a pure cost. You pay money to make problems go away. But because the agent can instantly pivot from "here is how you fix the vacuum" to By the way, here's a fresh filter for that vacuum on sale. It drives revenue. It focuses on lifetime value.
So Shark Ninja's about speed and sales. But then we have Wyndham Hotels. This one felt different. This was about scale and, frankly, removing the human from the loop entirely in some places.
The scale at Wyndham is massive. It's the largest hotel chain in the world. They have 5,000 deployments across 8,300 hotels.
The CEO, Jeff Bellotti, described the before scenario, and anyone who has checked into a hotel recently knows this exact pain.
Right. You walk up to the front desk. The human agent is there, but they aren't looking at you. They are staring at a screen, typing furiously, trying to find your reservation, asking you for your address for the third time.
It's friction. The technology is actually getting in the way of the hospitality.
Exactly. So their after scenario is what they call humans with agents. The AI agent, using that data 360 layer we talked about earlier, pulls up encyclopedic knowledge of the guest before the human even says hello.
But it goes further than just pulling up info, right? The agent is actually taking action autonomously.
This is the autonomy part. The AI is booking guests into their preferred rooms automatically. It is upselling suite upgrades. It's even selling pet amenities.
Wait, selling pet amenities?
Yes. If the historical data shows you travel with a dog, the agent autonomously offers the pet package to you. The human doesn't have to remember to ask. It just happens.
And the overall impact of this?
0 hold times. Millions of dollars in labor costs removed from franchisees. And this is the big one for their business model. A 200 basis point increase in direct bookings.
That's crucial, because if I book directly, Wyndham doesn't have to pay a massive commission to Expedia or Booking.com.
Precisely. So the agent is improving the guest experience, it's cutting labor costs, and saving on third-party commissions all at once. It's the perfect case study for the agentic enterprise.
It sounds like they're removing the robot work from the human, so the human can actually be human.
That is the optimistic view, yes.
Well, let's look at the slightly less optimistic view, or at least the more radical one. The story from Jason Lemkin at Sastra.
This was the example that likely sent a chill down the spine of every sales rep listening to that call. Sastra is a community for software founders, so they're much smaller than Wyndham, but they are highly influential. Jason described transforming his own internal team.
He went from 15 humans down to 2.5 humans and 20 agents.
2.5 humans.
I assume the 0.5 is someone working part-time.
Yeah.
But still, that is an 80% reduction in headcount. I have to say, that sounds incredibly efficient for the business, but if I'm one of those 12 and a half people who aren't there anymore, that is terrifying.
It creates a massive tension, absolutely. It forces us to ask what happens to the roles that get replaced. But from a strict business owner's perspective, which is who this earnings call is aimed at, look at the output. He said those agents closed $2.7 million in deals.
That is real revenue, and he gave a specific example of how they did it involving a Freshworks lead. This was fascinating to me because it really showed the difference in behavior between a human and an agent.
It is a classic sales problem. Sastra had a lead from a company called Freshworks, but the human contacts they knew at that company had left.
Which happens all the time. People change jobs. Usually that lead is just dead.
For a human sales rep, yes. It takes way too much time to hunt down the new person, find their email, and warm them up from scratch. You just move on to the next easy call. But the agent doesn't get tired. It doesn't get discouraged.
So what did it do?
The agent went out, identified the new decision maker at Freshworks, reached out with personalized context, and closed the deal, all on its own.
That is tenacity that is really hard to hire for.
It is scalable tenacity.
Yeah.
And Jason made a prediction that I think stopped everyone in their tracks. He thinks the agentic side of the business could eventually be worth 3 to 4 times the software side.
Wait, explain that math for me.
Think about it. Today, you might pay $100 for a software license, but you pay $5,000 a month to the employee who uses that license. If the software starts doing the employee's actual job, the value of the software skyrockets. Companies will be willing to pay much, much more for the digital employee than they ever paid for the static tool.
So we are moving from hiring software to hiring digital labor.
That is the thesis.
If these agents are doing all this work negotiating deals, booking rooms, selling pet packages, where is it actually happening? Is there a new dashboard? Do they have digital cubicle?
This is the interface war, and Benioff is betting the house that Slack is the battlefield.
Slack. So the chat app is becoming the actual command center.
He threw out a fascinating stat to back this up. He compared Slack to X, formerly Twitter. He said X hosts about 500 million messages a day. Slack hosts 1 billion.
That is a staggering amount of work chat happening every single day.
It is, and Benioff's vision is that you shouldn't have to leave that chat to do your job. He told a story about meeting the CEO of Workday for drinks.
Right, he asked Slackbot for a briefing.
And because Slackbot has access to that Data 360 layer, the Salesforce records, the emails, the calendars, it just served up the strategy notes immediately right there in the chat. It's like having a chief of staff in your pocket.
That's impressive. But I want to talk about how Salesforce makes money on this. Because if I'm a shareholder, I am looking at all this AI compute costs, all those tokens we talked about earlier, and I'm getting nervous about profit margins.
Miguel Milano, their chief revenue officer, broke this down into 3 distinct buckets. First, you have upgrades. Moving customers to premium editions that have AI embedded, that's just standard software
So
economics.
that's just classic upselling.
Second is new seats. Because the ROI is demonstrably higher, companies are buying licenses for people who didn't have them before. But the third one is the new frontier. Consumption.
Flex credits.
Exactly. Think of it as fuel for the agents. 50% of their Q4 Agentforce bookings included these credits. It means the more work the agent does, the more AWUs it burns, the more Salesforce gets paid.
That perfectly aligns their incentives with the customer, doesn't it?
It does, but it also carries risk. In the old world, Salesforce got paid whether you logged in and used the software or not. In this world, the agent has to perform. If the agent doesn't close the deal or doesn't book the room, the customer stops buying credits.
So they are betting that the tech actually works. If the agent is incompetent, Salesforce loses revenue.
They are putting their money where their mouth is, and looking forward, they are incredibly bullish. They raised their fiscal year 2030 revenue target to $63 billion, and they are expecting organic revenue to reaccelerate in the second half of next year.
So bringing this all together, we have the financial fortress, the tech stack, the case studies with SharkNinja and Wyndham, and the new consumption business model.
Okay.
What is the one thing you think the listener should take away from this entire deep dive?
For me, it is the sheer speed of the transition. In just 15 months, Agentforce closed 29,000 deals. This isn't a slow multi-year rollout. It is a stampede.
It feels like we are moving from a world where we log in to do work to a world where we log in to assign work.
That's the shift. We are becoming managers of digital workforces. And that changes everything about how a company is structured.
Which leaves me with a somewhat provocative thought to end on today. We talked about Jason Lemkin's prediction earlier that the agent business could be 3 or 4 times the size of the software business.
Right.
If that happens, what is a tech company anymore? If I'm a CEO and I have 2.5 humans and 20 agents, and the agents are negotiating my contracts and handling my customers, am I running a company? Or am I just the administrator of a really complex piece of code? And if an agent can negotiate a contract for you while you sleep, who's actually running the show?
That is the multi-billion-dollar question. And as these agents get smarter and more autonomous, the line between employee and software is going to vanish completely.
Something to think about while you check your own agentic work units for the day. Thanks for joining us on this deep dive.
See you next time.